Good morning, and thanks so much for joining in. You're watching BQ Prime. My name is Alex Matthew, and we're here to talk about possibly the biggest headline of the week so far, and certainly the biggest headline heading into trade today. And that is the fact that US CPI has cooled more than expected. CPI stood at 3.2% in the month gone by, and that was lower than consensus estimates of 3.3%. Has inflation peaked? What does this mean for US monetary policy? And therefore, what does it mean for global equity markets and our markets here in India? To talk about some of that, I'm joined by Jeffrey Dennis, independent emerging markets commentator. Jeff, thanks so much for taking the time. Really appreciate your taking the time. Let me start with the question: has inflation peaked? And if it has, what are the implications for markets globally?
Oh, inflation has definitely peaked, and I think what was important about the report today was the fact that obviously, as you said, it was better than expectations, lower than expectations, but also the year-on-year rate came crashing down from 3.7 to 3.2, which is almost back to the low that it got to in June. And so that was a positive surprise. And if I can just make this comment about the number, I think today's report was always it was kind of easy, I think, to predict that it would be a good surprise because energy played a huge role. And when energy jumps a lot or falls a lot, the inflation rate tends to overshoot. We got the benefit of a dramatic fall in energy prices in today's CPI. And therefore, I think that's what created, if you like, the backdrop for this big rally. Now, and I'm sure we're going to talk about this. Basically, it gave real additional evidence that the Fed is finished hiking, which is now my view for sure. I think we're quite a way away, however, from the first rate cut from the Fed. But it gives confidence to the markets that the Fed is done, despite Fed Chair Powell's comments last week, which were quite hawkish. And you got a classic risk-on reaction. Equities up, bond yields sharply lower, down below 4.5%, and also a weaker dollar, which, as I argue continuously, is particularly good for the emerging markets.
I want to come to two aspects of that. Now, ordinarily, in any given year, Jeff, a 19 basis points fall in a bond yield on the 10-year would be headline, big news. But over the last couple of weeks or the last 5 weeks or so, the kind of volatility that we've seen in treasuries has been unprecedented. And so therefore, this is par for the course. Are we done with some of that, though does it settle? Because as you say, I think a lot of market participants are now pricing in that we're done with the rate hikes. So therefore, we shouldn't see too much of a spike from this point. And the second point is the dollar index. We saw it come off overnight. 104 thereabouts is where it is right now. Does it come off more according to you, and what are the implications? Spell that out for us.
Well, I'm too old, and I remember days, weeks, months of much, much bigger moves than even the big move we had in bonds today. But certainly you've had tremendous volatility in bond yields in 2023, and that's been unusual compared to the last several years. We had a big rally, then it poured. Yields went from 5 to 4.5. They bounced back a little bit. Now they had a big move down. Today, I don't think they're going to go a lot lower in the near term. I think they will go lower. My own model is telling me that inflation in the US probably hits somewhere near to 2% in the second half of next year. So that'll bring yields down a little bit more. But I'm not sure we're going to see any more than another 30, 40 basis points over the next several months to the downside. We've seen a good move already. I think that's point number one. The other point that I think supports that view is the fact that on a day like today, nobody cares about the supply side. But the supply side of the US bond market is what really troubled the markets as the yields pushed up to 5% recently, because the US is running an enormous budget deficit. And with that, you're getting a big supply of bonds coming onto the market. And of course, the Fed is reducing the size of its balance sheet. So I think you're still going to worry about the supply side here. But for now, today with this downside surprise in inflation, lower than expected inflation, the demand for the bonds was very, very high, and that's what pushed the yields down very sharply. They go lower still. I'm not sure they go that much lower, maybe, as I say, 30, 40 basis points over the next few weeks and months. On the dollar, I've been bearish dollar for a long time, and it's not really worked out. I think the dollar does go lower as it becomes clear the Fed is finished tightening, and bond yields will go lower, and eventually the Fed will start to cut rates as well. The backdrop here is, although growth is good in the US compared to European growth, which is not good, which is certainly weakening the euro to a certain extent, the issue with the US continues to be, as I said a few moments ago, a very big budget deficit and a very big trade deficit. And I think that will be the dominant driver of a lower dollar. So I think the dollar continues to fall. It'll fall erratically. It's had a good move down in the last few days. Maybe it pauses. But I think dollar euro, which is between 108 and 109 today, is going to head towards 115 over the next 6 to 12 months.
Okay, all right. So that's important to watch. The last leg of this conversation, I'd like to focus on the rate cut scenario. I guess the attention starts shifting towards, and the bets start pooling about when that rate cut takes place. Some have said it could be as early as June next year. Is that optimistic? And obviously, this depends on the US economy, which has stayed quite resilient, Geoff, and the wages data, which I was looking at as well. The real wage growth seems to exist. It's there.
Yes, I think the wages are still something you have to watch, and that could they could lead to some, if you like, slowdown again in the pace at which inflation comes down. And as your viewers will know very well, we've seen a lot of high-profile wage settlements, particularly in the auto industry, but also with the Hollywood actors and producers, etc., but also earlier in the year with UPS, for example, the parcel delivery service. But at the end of the day, I do think that sufficient downside is happening here on inflation going forward, and wages will stay under control, that you can talk about rate cuts down the road. Now, there are two reasons why the Fed will cut rates, in my view, probably in the second half of 2024, or the two possibilities to why they cut rates. One is we actually go into recession, which I think is now a diminished possibility. It is possible, but it's much less likely, I think, than it was a few months ago. But if that were to happen, for example, in the first half of next year, they cut rates then. So you've got to watch the economy, see if it doesn't slow down too much. And then, of course, in the second half of next year, if inflation is pushing towards 2%, and interest rates are still 5.25% to 5.375%, I'm sorry, 5.25% to 5.5%, forgive me, you're going to be in a situation where basically real rates are getting too high. And so with the economy doing well, there is no need for the Fed to rush. And I think the earliest they're going to move on my numbers would be the second half of next year. And I think the market could be disappointed, because the market, I think, is pricing in 4 rate cuts next year. And I just think that's too many.
Okay. The last question, and this relates, of course, to the Indian equity markets in the context of emerging markets. We've seen considerable selling from the equity markets here by foreign institutions. Now that this a major change in expectation, there was, until this point, I think till yesterday, a question mark about whether or not the Fed had one more hike left. Now that that's seemingly out of the way, what happens to flows, and how does India stand in the context of emerging markets, Geoff?
India has outperformed this year. Yes. It's up 2.5% in dollars. The EM index, as of now, as of a very nice move early on the 15th today, in Asia is up about 1.5% on the year. A disappointing year, frankly. But so India is up. So although the FII data has not been good lately, India has nevertheless outperformed. My sense is that you have had a perfect cocktail here for emerging markets. I wrote a piece about 3 weeks ago saying, what do you need for emerging markets to do well? Well, you need to, first of all, you need China to turn around, and there's some hint that China may be turning. I don't so much mean the economy, although that could be turning too, in terms of stronger growth, but also the market. You need confidence the Fed is at the peak and the 10-year yields are at the peak. Thirdly, you need above all a weaker dollar. And finally, you need some sort of sense the geopolitics is settling down. Now, I don't think the geopolitics is particularly settling down, for sure, especially in the Middle East. But the typical way in which geopolitics impacts markets is through something like the price of oil, which has been extraordinarily benign. So you've got a very, very good mix of events here for the emerging markets. I think EM does very well into year end and into 2024. And the FII money comes back, and I think India does well as well. I'd be overweight India. Of course, it's expensive, but then India is always expensive. And I think the growth story is great. There's potential down the road, perhaps for interest rates to be brought down as inflation drops. But at the end of the day, this is a good environment for EM, and that's going to bring the FII money, I think, back to a market like India.
Fantastic. Thank you so much, Geoff, for taking the time. Pleasure speaking with you. All right, viewers, there you have it. Comprehensive view on everything that you heard overnight on monetary policy, on inflation in the US, and of course, the most important factor from our perspective here in India, which is flows which could turn back to emerging markets and, of course, to India. Do stay tuned. Lots more coming up over the course of the day. This is BQ Prime.